When we talk about social capital, we're talking about the value that's locked up in all the relationships that exist between us. And so there's maybe relationships that you have with your family, there may be relationships you have with people you work with, in your community, and in society as a whole. There are really three types of social capital. There's something called bonding capital, which is the social capital that exists between you and, for example, your partner, maybe between you and the people you work with. So it's capital where there's high frequency of contact, you share lots of practices, lots of norms, and you know each other very, very well. You get bridging capital, which is the type of capital that exists between similar people who just don't come into contact that frequently. So it may be people who do similar jobs to you, but in another company. And then you have linking capital, which is the hardest capital to maintain because it's a sort of capital that exists between, for example, an employee and the CEO of the company. So not only do they not share practices, but there's some sort of hierarchical difference between them. Historically, brands have obsessed with building what we call bonding capital. They want an exclusive private relationship with you. It's for people like us. What this does is it eliminates the other types of social capital. If you think in a way, bonding capital is literally your comfort zone. It's what you know, it's what you're comfortable with. So we naturally gravitate towards bonding capital environments. And brands have exploited that very, very well for the last 50 or 60 years. Only now we're going through this phase of what Philip Pullman calls this sort of wakefulness. We're starting to realize that actually we are connected in other ways that may be less convenient, but are actually very, very important to us. And what brands now need to do is understand that they need to reflect that change, that we no longer want these intoxicating, exclusive relationships. We want to belong to more open and more fluid and contrasting relationships. And brands run the risk if they don't recognize this, if they don't reflect this, if they don't represent that experience for consumers, they're going to become redundant. We think there are three stages to building social capital. There are three things that brands need to be good at doing. They need to be good at talking, which you'd say most brands probably are, but actually you need to be able to talk and be listened. So it's a different type of dialogue that's needed now. Consumers don't want necessarily this very intoxicating transactional relationship with brands. They want an experience that is more community-based. That demands a different type of dialogue. The second part of that is shared thinking or engagement in many ways. And again, the conditions for engagement are now very, very different. And what comes out of those two parts is trust. And this is not only trust towards the brand, this is trust that is shown in the confidence, if you like, of reciprocity between all those people in that community. So it may be trust with people that you know very well and you come into contact with every day, but it may also be trust with people who are literally on the other side of the planet. If we want to try and find an example or try and illustrate why social capital is important, so we're talking at a business level, but also at a society level, think about when you go about most of the stuff you do outside of your home every day. Say, for example, taking a train journey. You have to buy a ticket. There'll be CCTV. There'll be barriers to get onto the platform. You get onto the train. There'll be a conductor to look where you sit. All these are mechanisms that are put in place because social capital isn't as high as it should be, because there's not enough trust. Now, you may think you don't actually personally pay for those, but actually you do, because it's in the price of the ticket. It costs the rail company and everyone else a lot of money to do all that. And that's an example of where low or imbalanced social capital costs us. The same thing can be said for brands in terms of how they engage with, how they interact with their constituents. If you have high transaction costs in those relationships, it's going to cost the business a lot of money. But if you can encourage an environment which is high in social capital, then the amount of trust that's in those relationships goes up. It still needs structure, it still needs form, but it can be far more flexible, far more fluid. And the brand, on behalf of the business, can uncover a lot of, up until this point, unseen value. So you may get more tacit information from your consumers about what they're looking for. You may be able to put things into the market that you may not think are quite ready yet, but you know that you'll get positive feedback. These are all examples where if a brand has created high social capital amongst all those people that it interacts with, you can do an awful lot more. A good example of social capital at work is a piece of research that came out of Stanford a few years ago. And even though they weren't specifically looking at social capital, I think when you look at the experiment through a social capital lens, you can see the constructive power of social capital. And in this experiment, they created a new photo sharing and sort of album printing website. And they gave this site two distinct brands. So even though the back office was exactly the same, you had some consumers were enlisted to use the site, and they were experiencing it through a very sort of fun, lively, and friendly brand. And a second group of consumers were experiencing it through a brand that was positioned around austerity and seriousness and a sort of grown-up responsibility to catalogue your photographs. And then what they did is they caused that site to fail. So both audiences suffered loss of photographs, loss of albums, loss of contacts, all their interaction with the site was lost. And then they looked to see what happened to the relationship those consumers had with those two different brands. And what was interesting is the brand that was very austere and serious never recovered its relationship with its consumers. But the brand that was more innovative, more friendly, more dynamic, recovered this relationship very, very quickly. In fact, it exceeded its previous relationship. And I think this is a really good example of where that second brand, in their particular market and for their product, had generated higher social capital amongst its users. Okay, if we talk about social capital being these three things, it's the type of dialogue you have, it's the type of thinking that you encourage as a result of that dialogue, and it's the amount of trust that develops out of those two things. What that second brand had done is more effectively built these three components of social capital, and it gave them potentially a life-saving opportunity at the end. Now, the reason that example is very useful in the context of sustainability, we're at the point now we're in the low-hanging fruit of sustainability, the sort of easy wins are gone. What we now have to do is make some very tough choices, and consumers have to be a part of that. Now, what a brand can do with high social capital is approach those choices. It can basically experiment with what may or may not work, and it can do so in an environment where it is at least more confident that it will not be penalized by those consumers, because those consumers will be crediting the brand for high social capital. So even though a lot of people talk about sustainability gives the business license to operate, depending on the relationship the brand has with its constituents, depending on if the brand is good at nurturing social capital, what that brand gives the business is a license to innovate. So the main thing about social capital is it removes transaction costs. And transaction costs are an incredibly expensive, cumbersome bit of sort of industrial era machinery that brands seem inadvertently reluctant to let go of.